Hello and welcome to CIMA F1 Financial Operations, Chapter 5, Predictive Value. This chapter covers two international accounting standards, and this particular video will cover one of them, IAS 8. It will be a separate video on IFRS 5 covered by this very same chapter. We would like to emphasize from the very beginning that most stakeholders, when they take an annual report in their hands, they would expect from that information to have a power of prediction. In other words, if you're a stakeholder, let's say a shareholder, and you're looking at your return on investment, it's interesting to assess it as at today, as at a point in time, but it's even more powerful and more useful to them to assess it in the next year and the next year. And the question is financial information providing that sort of relevance, that power of prediction? And these buzzwords, relevance and reliability, we covered it in the framework document, and we were saying that the more of one, the less of the other. So if you think the financial statements as such are reliable, so if you talk about the financial statements and you look at one of these qualities of information, reliability, yes, they are reliable. But are they relevant? Not as much, because they don't reflect necessarily a pattern for the future. They just reflect in a reliable form, assuming all the IFRSs have been correctly complied with, in a correct form, the past and not the future. So in an attempt to do so, there are various standards, and two particular ones are emphasized in this chapter. The first one is IAS 8, which tells us how to deal with changes in accounting policies by different companies in order to still allow relevance and reliability to the information, how to deal with changes in accounting estimates, and ultimately how to deal with accounting errors. And if we're going to take the first thing that IAS 8 deals with, changes in accounting policies, I would like to emphasize that this can be done in very rare situations. For instance, when a country goes from local GAAP to an international GAAP, let's say IFRS, then that would be a change in accounting policy that is permitted, and that does happen very seldom, isn't it? And when that is the case, when you go through a change in accounting policy, what you have to do is to make sure you restate the previous year's figures. So if you picture your financial statements having your current financial figures for the current period reported, and then you have at least a minimum of a comparative year presented, that is the past year, what you have to do when you change accounting policies, all the implications arising by applying the new standards will be applied to the previous year. That doesn't mean you're changing the annual report of the previous year, but you're changing just the brought down figures on assets, liabilities, and equity. So the only connection with the past you have are the brought down figures in the statement of financial position of the previous period. They have to be adjusted. That would be for comparison purposes, to making information more relevant and useful to the stakeholders. And that is what we call retrospective adjustment. Now, I would briefly like to talk about accounting estimates. What is an accounting estimate? Of course, you can read those notes that you all downloaded from our website in more detail, and you have to do a lot of question practice to make sure you understand how to apply and exercise professional judgment. But as a simple example, think of useful life of your non-current assets. Let's say you had a non-current asset, and when you bought it, you thought, okay, I'm going to keep it for maybe 10 years. But the thing is, 2 years passed by and you decided you're not going to hold it for the remaining 8 years. Remember, 10 years useful life? You're going to hold it for 2 more years. So all in all, it remains a useful life of, well, it becomes a useful life overall of 4 years. So what do you do then? You decided this year you're going to make the change. All you do, you're going to take the net book value of that asset and depreciate it faster on the shorter remaining life you decided upon, 2 years instead of remaining 8. This example is just very brief. It doesn't really matter the numbers as such, but the principle would be that in case you change an accounting estimate, you're not doing any retrospective adjustments to financial information. You're going to just do prospective, so you're going in the future. In other words, the current period is affected, but the next periods as well. In this particular case I gave, you have to depreciate faster, so higher depreciation expenses will be included in statement of comprehensive income. Okay, hope that makes sense, and we could move to the last element that is presented by this IAS 8 we are covering now, accounting errors. So imagine you are hired as an accountant or a management accounting even, and you hear about an error that comes from 5 years ago. Okay, it's very important to refer to it as an error, and IAS 8 makes reference to these errors as omissions that basically you could have they could have not happened, and you expect that information was available in order for this error not to have occurred when financial statements for those particular periods were authorized for issue, and also that was reasonable and expected to have been obtained or be available, as I said, in terms of preparing financial statements. So if that is the case, if that information was available and you could have reasonably expected that, it is an error. And what do you do now? Exactly like for accounting policies, you are adjusting retrospectively, you are adjusting the brought down figures into your assets, liabilities, and equity depending how they're affected. So you want to make sure that with an accounting error you do include it as you discover it. And if you know, companies do prepare a minimum of 1 year comparative. Sometimes they provide 2 years, previous 2 years as comparative. Let's say if the error comes from last year, of course you're not going to go 2 years back and adjust brought down figures. But if the error comes 5 years from 5 years ago, you're going to adjust the 2 year ago figure, the last year figures, all in order to make it comparable with the current period you are in. So everything we said here, it's in your notes and basically it's summarized. But remember, Express Notes provide you just the highlights. The videos reinforce certain highlights of these standards and chapters. You want to make sure you do enough question practice on all these standards, and ultimately the most interesting part is when you put them all together. Thanks very much for listening, and look forward to being in touch with you again for the next videos. All the best.